Most people lose money in the stock market not because they pick the wrong stocks, but because they skip three critical steps before they ever hit the buy button. These are not complicated steps. They are simple, they are proven, and the greatest investors in history all swear by them. Yet, almost nobody does them. Today I am going to walk you through the three things you absolutely must know before buying any stock. Get these right, and you will already be ahead of the vast majority of investors. Get them wrong, and it does not matter how great the company is, because you will still end up losing money. Let us jump into number one. This is the one that most people completely ignore. You need to understand what the business actually does, and whether it falls within your area of knowledge. Warren Buffett calls this your circle of competence. Every person has industries they understand well through their job, their education, or personal interest. And there is a massive universe of things they know very little about. Buffett's advice is to invest only within that circle. He once used this analogy about cars. At the start of the 20th century, around 2,000 automobile companies existed. If you had been alive back then, you might have correctly predicted that cars would transform the world. But out of those 2,000 companies, only about 3 survived long-term. Knowing a technology will change the world and knowing which specific company will win are two completely different skills. Right now, everyone is excited about artificial intelligence. AI is clearly transforming industries. But can you explain how a specific AI company makes money? Do you understand its competitive advantages, who its customers are, and why those customers would not switch to a competitor? If you cannot answer those questions, you are not investing. You are gambling. Here is what I recommend. Before you buy any stock, write down in plain language what the company does and how it generates revenue. If you cannot explain it simply, like you are telling a friend over coffee, then you probably do not understand it well enough to invest in it. Peter Lynch generated 29% annual returns for 13 straight years. He had the same philosophy. He loved investing in businesses he encountered in everyday life. He noticed trends at shopping malls, restaurants, and stores long before Wall Street caught on. That is how he found massive winners early. Do not buy a stock because someone on social media told you it was going to the moon. Do not buy it because the chart looks exciting. Buy it because you genuinely understand the business underneath that ticker symbol. Now let us move to number 2. You need to know whether the price you are paying is actually reasonable. Here is the thing that trips up so many investors. A great company is not automatically a great investment. The price you pay matters enormously. You could find the best business in the world, but if you pay way too much for it, you can still lose money. The most well-known measure is the price-to-earnings ratio. You take the current stock price and divide it by the earnings per share. So if a stock trades at $50 and earns $5 per share, the ratio is 10. That means you are paying $10 for every dollar the company earns. Generally, a lower number suggests you are getting more earnings for your money. But here is where it gets tricky. A company with a ratio of 30 might actually be a better deal than one at 10 if the first company is growing its profits much faster. If a company has a ratio of 30 but is growing earnings at 30% annually, the growth-adjusted ratio is 1, which suggests the price is fair. If another company has a ratio of 10 but is only growing at 5%, its growth-adjusted ratio is 2, meaning you are actually paying more relative to the growth you are getting. Peter Lynch took this even further by factoring in dividends. He believed that if a company is paying you cash while you wait for it to grow, that should count for something. The key insight is that cheap and expensive are relative terms. Always compare the price to what the company actually delivers in earnings, growth, and cash returned to shareholders. Buffett talks about building in a margin of safety. Imagine you are driving a heavy truck across a bridge. If the bridge is rated for 10,000 pounds and your truck weighs 9,800, you might feel fine if the bridge is just a few inches above a shallow stream. But if that same bridge stretches across a deep canyon, you would want a lot more room for error. Investing works the same way. The riskier the investment, the bigger the gap you want between the price you pay and what you believe the company is actually worth. That buffer protects you when things do not go exactly as planned, and things almost never go exactly as planned. All right, Number 3. This is the one that separates people who build real wealth from those who constantly spin their wheels. You need to know yourself as an investor before you buy anything. You have to have clarity on your financial situation, your goals, and your emotional temperament. First, your financial foundation. If you have high-interest credit card debt sitting at 20 or 30% interest, investing while carrying that debt is like trying to fill a bucket that has a giant hole in the bottom. The stock market has returned around 8 to 10% per year on average. If your debt is costing you more than that, you're actually losing ground by investing before paying it off. Same with an emergency fund. Life happens. Cars break down, medical bills pop up. If you do not have cash set aside, you might be forced to sell your investments at the worst possible time, right in the middle of a market downturn. Have 3 to 6 months of essential expenses saved in an easily accessible account before you start investing. Second, your goals and time horizon. What are you actually investing for? Retirement in 30 years? A house down payment in 3 years? Money you need within the next 5 years generally should not be in stocks, because the short-term volatility can be brutal. But money you do not need for a decade or more has historically benefited enormously from staying invested through the ups and downs. The stock market has crashed 19 times in the past 150 years. Every single time it recovered and went on to reach new highs. But it only benefits you if your time horizon is long enough to weather those storms. Third, your emotional readiness. Buffett himself says that if you are emotional about investments, you are not going to do well. When the market drops 10 or 20%, and it will drop at some point, what are you going to do? Are you going to panic and sell everything? If that is your instinct, you need to be honest about it now, before you have money on the line. The investors who build the most wealth over time are not the ones who make the most trades. They are the ones who stay calm, stay consistent, and stay invested. Fidelity once looked at which of their accounts performed the best. The top performers belong to people who had essentially forgotten they even had an investment account. Doing less often produces better results than frantically buying and selling. One practical tip that ties all of this together is automation. If you set up a regular monthly transfer into your investment account, you remove emotion from the equation entirely. You invest the same amount whether the market is up or down. Over time, that consistency compounds into something remarkable. Let me tie all 3 of these together. First, understand the business. Make sure it falls within your circle of competence so you actually know what you own. Second, evaluate the price. Use valuation metrics to determine whether you are paying a fair price. Build in a margin of safety. Third, know yourself. Get your financial house in order, define your goals, and set up systems that protect you from your own emotions. When you combine these 3 steps, you stop reacting to headlines and start making decisions based on logic and evidence. You stop chasing whatever stock is trending on social media. Most importantly, you gain the confidence to stay invested through the inevitable rough patches, which is ultimately what determines your long-term success. If you found this helpful, make sure to subscribe. And if you know someone who has been thinking about buying their first stock, share this video with them, because these 3 things could save them thousands of dollars in mistakes. Thanks for watching.